There is a moment in every financial cycle that almost nobody notices. It isn't dramatic, it doesn't show up in headlines, and it doesn't arrive with collapsing prices or visible panic. Instead, something very specific simply stops happening. A transaction that once moved through approvals without discussion is no longer offered. A position that had been routinely renewed is quietly declined. A structure that depended on automatic continuation is allowed to expire. No announcement is made, no warning is issued, and no explanation is given because none is required. Inside large institutions, this moment is not debated, it is procedural. Before markets react, before volatility rises, before public narratives adjust, one trade disappears first. To understand why this happens, it helps to step away from how risk is usually described. Most people think risk is about losing money. For institutions, that is rarely the primary concern. Losses are expected. They are modeled and absorbed over time. What institutions cannot tolerate is the sudden loss of flexibility. Flexibility means being able to change direction without consequence. It means being able to exit positions quietly. It means knowing that funding will still be available if conditions shift. As long as flexibility exists, almost any position can be managed. Positions can be resized, exposures can be adjusted, mistakes can be corrected. But when flexibility becomes conditional, risk changes character. That shift does not require fear, it does not require panic, and it does not require belief that something dramatic is coming. It only requires recognition that certain assumptions can no longer be taken for granted. Large institutions are built on assumptions, not ideological assumptions, but operational ones. They assume markets will remain open. They assume counterparties will continue quoting prices. They assume collateral can be valued consistently. They assume short-term funding can be rolled forward without friction. As long as these assumptions hold, a wide range of trades appear safe. They generate modest, predictable returns. They exhibit low, apparent volatility. They fit comfortably within internal risk models. Because they work so reliably in stable conditions, they spread. These trades rarely attract attention. They are not associated with speculation. They do not look aggressive. They look like infrastructure. And infrastructure is only noticed when it fails. The trade that disappears first is defined by its dependency, not dependency on growth, not dependency on price appreciation, dependency on normality. It assumes liquidity will always be present when needed. It assumes counterparties will always be willing to transact. It assumes refinancing will be routine rather than discretionary. As long as those assumptions remain unquestioned, the trade is invisible. The moment they become uncertain, not broken, just uncertain, the trade becomes dangerous. This is not because it loses money, it is because it cannot be exited cleanly. This distinction matters. Institutions do not abandon trades because they expect losses. They abandon trades because they expect friction. Friction is the enemy of scale. A position that can be exited at will is manageable. A position that requires cooperation to unwind is not. So when conditions begin to tighten quietly and unevenly, institutions do not rush to sell assets. They begin by asking a simpler question: which positions depend most heavily on everything continuing to work as expected? Those are the positions that go first. This process does not happen in public. It happens inside committees, risk reviews, and internal dashboards. Language shifts subtly. A position that was previously described as routine becomes reviewable. A structure that was considered stable becomes conditional. A counterparty that was assumed reliable becomes subject to limits. No one says the system is in trouble. No one needs to. The decision is not about danger. It is about optionality. Optionality is the ability to choose later. The trade that disappears first is the one that removes that choice. This trade is rarely defined by an asset class. It is defined by structure. It typically involves short-term funding supporting longer-term exposure. It often relies on collateral whose value is assumed to be stable. It depends on the willingness of multiple parties to participate without hesitation. As long as participation is automatic, the trade works. When participation becomes discretionary, it does not. The earliest signal that conditions are changing is not volatility, it is selectivity. Institutions become more selective about where they deploy balance sheet. They become more selective about which counterparties they engage with. They become more selective about which positions they renew. This sell activity does not show up in prices immediately. Markets can remain calm while behavior changes underneath. That is why this moment is so often missed. Most observers look for signals in charts. Institutions look for signals in behavior. They notice hesitation. They notice tighter terms. They notice delays where none existed before. None of this is alarming in isolation. Together, it tells them that flexibility is no longer guaranteed, so they respond accordingly. They stop initiating the trade. They stop expanding it. They allow existing positions to wind down naturally. From the outside, nothing appears to be wrong. Volumes may remain high. Prices may continue rising. Commentators may point to stability as evidence that concerns are misplaced. But inside institutions, posture has shifted. The system is no longer being optimized. It is being protected. What makes this phase difficult to observe from the outside is that it does not look like decision-making in the conventional sense. There are no dramatic votes, no sudden reversals, no declarations that conditions have changed. Instead, parameters are adjusted, risk limits are nudged, haircuts widen slightly, tenors shorten, approvals require one additional sign-off. Each change appears minor, but together they alter the environment in which certain trades can exist. The trade that disappears first is the one that cannot survive this drift. It does not fail outright. It becomes inefficient. It requires stability, not just in prices, but in process. It requires funding to roll without discussion, collateral to be accepted without scrutiny, counterparties to remain interchangeable. The moment any of those assumptions becomes conditional, the trade no longer fits. Not because it is prohibited, because it no longer clears frictionlessly. Large institutions are extremely sensitive to friction. They operate at scale, and scale magnifies inefficiency. A small delay at low volume is tolerable. The same delay at scale becomes a constraint. So institutions remove anything that introduces uncertainty into operational flow. This is why the first trade to disappear is rarely controversial. It is not aggressive, it is not speculative, it is often the most ordinary. Its risk lies not in what it earns, but in what it assumes. It assumes continuity. Continuity of liquidity, continuity of pricing, continuity of cooperation. When those assumptions weaken, the trade becomes fragile, and fragility is unacceptable at scale. This decision does not require consensus about the future. It does not require belief that conditions will deteriorate. It only requires recognition that the margin for error has narrowed. Institutions live within margins. They monitor how much deviation can be tolerated before action is forced. When volatility is low and liquidity abundant, margins are wide. When liquidity becomes selective, margins shrink. As margins shrink, behavior adjusts incrementally. The trade is still permitted, but under tighter terms. Then only with stronger counterparties. Then only at smaller size. Eventually, it is no longer worth maintaining, not because it fails, because it no longer fits. This is how the trade disappears. It is not banned, it is starved. And this starvation is largely invisible. From the outside, activity continues, deals are still executed, prices are still quoted, liquidity still appears present, but it is conditional liquidity, available only to certain participants, available only under specific terms, available only for structures that tolerate scrutiny. Liquidity does not vanish all at once, it stratifies. Flexible participants retain access. Dependent structures lose it first. The trade that disappears first is the one that requires broad participation to function. It depends on many actors behaving as if conditions are normal. When even a few hesitate, the structure weakens. Institutions sense this hesitation early. They see it in slower responses, in revised terms, in the language of negotiation. None of this is public, but it is decisive. So institutions adjust. They stop allocating balance sheet to structures that assume cooperation. They favor positions that can be exited unilaterally. They favor simplicity over efficiency. This marks a critical shift. Efficiency depends on trust. Resilience depends on autonomy. When conditions tighten, institutions choose autonomy. They prefer positions that do not require explanation. They prefer trades that can be unwound quietly. They prefer exposure that can be reduced without negotiation. The trade that disappears first fails these tests. It cannot be unwound without counterparties. It cannot be reduced without signaling. It cannot be exited cleanly once conditions change. so it goes first. This often happens while public indicators remain calm, economic data may appear stable, market indexes may continue rising, volatility may remain contained. This creates confusion. Observers expect visible stress before behavioral change. In reality, behavioral change comes first. Institutions respond to conditions as they experience them internally. Those conditions are not captured by headlines, they are captured by flow, by how easily transactions clear, by how readily balance sheet is offered, by how quickly problems are resolved. When these processes slow, institutions adapt. They do not announce the adaptation, they embody it. This is why the first sign of tightening is not a collapse, it is a subtle shift in availability. A trade that once existed is no longer accessible on the same terms. A structure that once functioned smoothly now requires negotiation. Over time, these changes accumulate. The system becomes less elastic. Small shocks persist rather than dissipate. Pricing becomes less continuous. Depth thins. None of this implies immediate failure. It implies reduced tolerance. The system still works, but it demands precision. Timing matters more. Positioning matters more. Errors matter more. This is why later stage environments feel different before anything breaks. They are less forgiving. Participants sense this even if they cannot explain it. They attribute it to sentiment or regulation. In reality, they are responding to the same constraints institutions have already internalized. The first trade disappeared quietly. Everything else is adjusting to its absence. Historically, this moment is misunderstood. Later narratives focus on dramatic events, but those events are consequences. The cause was earlier. It was the withdrawal of flexibility. The moment institutions decided certain assumptions were no longer safe. That decision did not require panic. It required discipline. And discipline at scale looks like quiet withdrawal. What makes this phase so difficult to recognize in real time is that nothing appears to be failing. Institutions are still operating, markets are still open, transactions are still clearing, but the system is no longer behaving as it once did. It has hardened. Hardening is not collapse, it is reduced tolerance. The system still functions, but it requires precision. Errors that would previously have been absorbed now produce consequences. Small mismatches persist instead of resolving automatically. This is what the disappearance of the first trade sets in motion. That trade played a specific role. It absorbed uncertainty. It smoothed flows. It allowed imbalances to exist without immediately becoming problems. When it disappears, the system loses a layer of insulation. Nothing breaks immediately because the insulation was behavioral. It relied on willingness, on cooperation, on the assumption that participation was automatic. Once that assumption is withdrawn, everything downstream becomes conditional. Institutions do not attempt to replace the trade. They accept its absence as a constraint. And once a constraint is accepted, behavior reorganizes around it. Balance sheets are allocated more carefully. Exposure is concentrated where exits are clean. Positions are sized with less tolerance for error. This reorganization does not show up in public metrics. Risk models may still suggest stability, but the lived experience inside institutions changes. Decision makers feel the narrowing. They become more conservative not because they expect disaster, but because they feel less room to maneuver. The system no longer feels expansive. It feels tight. This sensation is subtle, but widely shared among those operating at scale. And because it is shared, it becomes self-reinforcing. Each institution assumes others are adjusting similarly, so they adjust preemptively. This is how tightening propagates without a visible trigger, not through fear, through inference. Institutions infer that selectivity is increasing. They infer that cooperation may not be guaranteed. They infer that optionality is declining, so they act accordingly. This collective adjustment produces a system-wide shift without coordination. No declaration is required. The regime changes because the conditions supporting the previous one no longer exist. This is why public explanations often miss the mark. Observers search for causes in visible events. They point to policy decisions, data releases, or geopolitical developments. These may contribute, but they are not the initiating force. The initiating force is the withdrawal of an assumption, the assumption that certain trades can always be made. Once that assumption is gone, the system must adapt. Adaptation always favors resilience over efficiency. Resilience is slower, more expensive, less elegant, but it does not require everything to work perfectly. Efficiency does. The trade that disappears first is an efficiency trade. It exists to optimize within a stable environment. When stability becomes conditional, optimization becomes dangerous. So institutions choose resilience. They accept lower returns in exchange for control. They accept friction in exchange for survivability. This choice is rarely framed explicitly. It is embedded in process. Over time, the shift becomes visible indirectly. Markets feel different. Liquidity appears present but behaves unevenly. Depth looks sufficient until it is tested. Volatility remains contained until it does not. Participants sense this change even if they cannot articulate it. They describe markets as thin, fragile, or uneven. These descriptions reflect a system that has lost elasticity. This moment is often misunderstood in hindsight. Later narratives focus on dramatic outcomes. They identify collapses or interventions as turning points. But those events are consequences. The cause was earlier. It was the quiet withdrawal of flexibility. The moment institutions decided certain assumptions were no longer safe. That decision was rational, it was disciplined, and it was invisible. This is why hindsight so often misleads. After disruption occurs, narratives search backward for signs. But the most important signal was never public. It was behavioral. It was the absence of something that used to be there. Institutions do not wait for certainty. They act when certainty declines. They do not require proof of failure. They require proof that assumptions are no longer reliable. When that proof appears, behavior shifts. Quietly, deliberately. First, there is no conclusion to draw from this, no instruction to follow, no prediction to make. The purpose of observing this pattern is not anticipation, it is understanding. Systems do not change when they break. They change when participants decide certain actions are no longer viable, and that decision always happens before consequences are visible. It is always reflected in the same way. A trade that once existed no longer does. Not loudly, not suddenly, but quietly. And that is how the system signals it is no longer operating the way it once did.